In this video, we'll deal with basic accounting in small firms. Now, the essential requirements for an accounting system to start with. First of all, it must provide an accurate picture of the financial state of the business. It must present an honest picture of the financial state of the business. Secondly, to enable comparisons of financial performance of the business over a number of time periods. So it should be able to compare how the business is doing currently with, say, how it was doing last year or 3 years ago or whatever. So it must be able to make comparisons and must be able to draw valid comparisons. So the basis upon which the comparison has been made is the same. So it enables performance to be monitored over a number of years. Number 3, to provide information as an aid to decision making. This is mostly used by management and creditors and the banks, but the information in the accounts must be honest, it must be drawn up accurately, and therefore represents the true state of affairs of the business. And this may be used by management in making decisions about investment or about engaging in some new line of production or some other activity, or just generally monitoring the business. So it may be used by management, but it also may be used by creditors, or say by the banks. If the banks were approached to for a loan to, let's say, make an investment in a new machine or in a new warehouse or whatever, then the banks would want to look at the current performance of the business, and that performance figure must be accurate and true. So the information may be used by a variety of sources. And fourthly, it must meet all the statutory reporting requirements, such as tax returns and value-added tax. So the requirements that are placed on businesses to be honest also extends to them paying the right amount of tax and being open about their dealings. Finally, they must provide a basis upon which monitoring may be conducted to investigate fraud and waste. So it's important that the business projects itself honestly and openly, and leaves itself open to be monitored for any wrongdoing. So it's easy for auditors or for the authorities to check to see if there's any fraud or any waste or anything that perhaps shouldn't be happening. So those are the basic essentials for an accounting system. Now, the accounting records system, well, types of internal accounting. We have accounts receivable. So the accounts receivable, monies coming into the business, perhaps from the sales of the products. The accounts payable in the form of wages, salaries, outgoings for the office expenditure, consumables as they're often called, raw materials, accounts payable, inventory, the amount of stock that the business is holding, the stock of raw materials, the stock of semi-completed goods or work in progress. The payroll itself, people who work in the business must be paid. They're working to receive an income, to pay their bills and look after their families and make expenditures that they need. So it's important that the business has sufficient funds to honour their obligations to their employees. So payroll is an important internal accounting process. Look after cash. Make sure that there's sufficient cash in the bank for day-to-day functioning of the business, and make sure there's a good balance in the portfolio between short-term cash that's available, let's say, immediately, and cash which may be held in deposits for a slightly longer period, but which will earn a rate of interest. So it must look after the cash situation of the business. And also fixed assets, such as buildings, machinery, office equipment. So it must look after the assets of the business. And there may be, depending on the nature of the business, there may be other factors. So I think we'd need to look into particular businesses to see if we could identify other areas of accounting need, where the accountants need to be involved and need to have separate sets of processes to deal with those. Now, methods of small business accounting. Well, computer accounting software packages, those are widely used. Sage have got a very well established set of accountancy packages, but many have got similar types of packages, and it makes keeping accounts very straightforward. They can be run on a laptop almost. For a small business, they could be run on a laptop. And the owner of the business may interrogate the accounts at any time and see exactly how the business is going and what are the issues. And the software is very sophisticated and is able to deal with a lot of the requirements for accountancy. It could be that the company employs outside accounting services, goes to a firm of accountants and engages their services to look after their accounts. Now, the computer accounting packages, well, these are automated record keeping and provide up-to-date information when required. They're very sophisticated. It means information is typed in and it's reflected in the various accounts that need to be affected. So the software allocates the information to the various accounts and prepares those accounts and prepares them on a continual basis. As the information flows in, the accounts are updated. So at any one moment in time, the person entering the data, the owner of the business, let's say, is able to interrogate the accounts, ask the accounts what's the current levels of profit or the current return on investment or whatever the particular package can do. It could deal with checkbook functions, although checkbooks are now becoming very rare as well as we move towards more electronic forms of payment. But in the olden days, it would certainly look at checkbooks functions, and when people wrote checks, then the accounts could be updated. The electronic accounts could be updated to show that a check had been written. The account in the bank would be dealt with accordingly, and the item purchased, that item would be entered into the accounts, and so it was double entry. The accounts were maintained in a double entry fashion. The software also prepares accurate financial statements for management decision making. Management, as I said, can look at the accounts at any time and can even play what-if games. What if we did this and what if we did that? What would be the implications, the financial implications on the business? So it's possible for management to almost experiment to see what would be the implications of certain decisions and work through the accounts. So it's quite a powerful function. Not only does it keep the accounts of the business, but it can be used for decision-making purposes also. And of course, it can monitor budgets, and the budgetary process is a very important function of business. There's a master budget which will look after the subordinate budgets, and each of those will have details of the amount of expenditure that's allowed in a given period, and there will be budget holders who are responsible for the accountability of those budgets. And in that way, the business is able to keep a rein, keep a check on its expenditure, so it may do it through budgets. And the software may also prepare final accounts. and this would be an extremely important function, because the final accounts may have to be lodged with legal authorities to ensure that the business is dealing openly and honestly, and there's nothing happening that shouldn't be happening. So it's a transparent process, and the software can generate the final accounts for the business. Outsourcing the accounting function. Well, this is a convenient way to deal with financial reporting requirements of the business. It's convenient because somebody else does the job for them. So if a small business is working hard making the product and getting customers and dealing with day-to-day situations, perhaps they don't want the extra problem of trying to complete their accounts and maintain a set of accounts and so on. So it's easier if they just simply keep a record of everything they've done that is financial, in withdrawals from the system and payments into the system and so on, and just report these to an outside agency, perhaps an accountant's, a firm of accountants, who will then deal with their accounts, and an appropriate set of accounts can be drawn up for legal purposes, but also perhaps for decision making. The accountants on the outside may be involved more than just simply drawing up the accounts for taxation purposes. They may be involved in decision making based on the accounts, and they may even attend meetings of the company. The outside company would of course have to be competent and reliable. Normally standards are assured by membership of the appropriate accountancy body. In the UK, accountants are regulated by the main bodies, the Chartered Institute of Accountants and various chartered institutes, who are extremely reputable bodies and ensure that standards are maintained at a very high level, and all of their members are highly qualified. Their examination processes are extremely difficult, so that people who practice as professional accountants are highly qualified and extremely professional individuals. No recruitment, training and administration costs. But we have to offset that with the in-house costs. So if for example, the accounts are given off to an accountancy firm, then the business doesn't have to recruit accountants and train accountants and look after the accountants and so on. So it doesn't have a separate accountancy function. Some other company deals with that, and they don't have to deal with it. But of course there's costs. The external accountants, the firm of accountants, will require fees, and the fees charged by them will have to be balanced against what would have been paid had the company maintained its own accounts with its own staff internally. So it's always the case that bought-in services have to be compared with what it would cost to produce them in-house. Accounting options. Well, we need to look in carefully to what we call cash and accrual transactions. Now, the cash method, well, revenues and expenses are recognized only when payments are received or expenses are paid. That's the cash method. We only enter into the accounts when revenues are received or when expenses are paid. It's the point of expenditure, the date on which we pay for the expenses. It's entered into the account, and it's entered into the account as that particular expense is paid. And likewise, we only enter into the accounts when we receive revenue, and this is known as the cash method. Now that contrasts with the accrual method. Revenues and expenses are reported when they are incurred, regardless of when they are received or paid. So the accrual method, whenever a sale is made, even though the money has not arrived, the money has not arrived in the bank, the sale has been made today, but still no payment is made, but the sale has been made, so it would be entered as a sale at this moment, even though the money has not arrived. The cash method would wait for the money to arrive and then update its records. With the accrual method, the moment the sale has been made, that's when the accounts are updated. The fact that the money is not here, well, that's a separate issue, and that'll be dealt with elsewhere. So the accrual method is in contrast to the cash method. The cash method is as soon as money arrives or money leaves, the accounts are adjusted. The accrual method, as soon as we have an obligation to pay, we have bought something, we still haven't paid for it, perhaps we bought it on credit, so we bought some raw materials on credit, let's say we've got 30 days credit, we bought them, so the fact that we bought them means that we are honor bound and legally bound to pay for those. But we will enter them into the accounts straight away, even though the money for them, the payment, has not been made. They enter into the accounts straight away. So two different approaches. Now we've also got something called single and double entry, which we need to just briefly look at. Single entry systems, well, a checkbook system of accounting reflecting only receipts and disbursements. So a checkbook system would be single entry. Let's say we have a single book, we buy raw material and we pay for it. So we just enter into the book that we paid so much for raw materials on this day, whatever the date is. That's single entry. It's quite straightforward. It's just a record of what we purchased. So it's raw materials purchased on a certain day, let's say, to the value of, and that's it. So the bank will show a debit. It'll be the balance in the bank will have been reduced, and the raw material stock will have been increased. So there are two sides to it, but only one side's really recorded, the side that says that we purchased raw materials, but no other records are updated. So it's single entry. Now, by contrast, the double entry system, it's a self-balancing accounting system that uses accounts that show receipts and expenditures, using credits and debits to show the accounts affected by every transaction. So every debit has an equivalent credit, so that overall the accounts must balance. The accounts must balance, otherwise there's something wrong. So go back to the example I had a moment ago with buying raw materials with the checkbook, when I talked about the single entry system. Well, if we were doing a double entry here, we would have, as I suggested earlier, we'd have two accounts affected. We'd have the bank, because now we've bought some raw materials, so the bank balance will be reduced. So that's come down. But our stock of raw materials will have gone up in value terms. And it'll have gone up by the amount by which the bank has come down. So if we buy raw materials for £1,000, the bank balance will be reduced by £1,000, but our stock of raw materials will have increased by £1,000. So overall, there's been no change. The accounts balance. One's come down, the other's gone up. And if we add the amount that's come down by the amount that's gone up, we get zero. So the accounts have not changed. The composition of our assets will have changed. We'll have less cash and we'll have more raw materials. So the composition of assets within the business has changed. But in terms of accountancy, the system balances. So double entry is an extremely important part of the accounting system. And this is the system that's used in businesses, the double entry system. Now that requires detailed consideration as a topic in itself, and I'm not going to do it justice in this video, but the idea behind it is very straightforward and is the one I've just given you, but it is important to be familiar with the principles of double entry. Now, internal accounting controls. Well, a system of checks and balances that safeguards assets and enhances the accuracy and reliability of financial statements. So, internal accounting controls means checking the balances, and it checks for accuracy, it checks for reliability. Sometimes people make mistakes, they enter the wrong figures, or it could be even worse, people are cheating and trying to cheat the accounts. Well, that's criminal. So we'll assume for the moment we're not really dealing with that. We're dealing with situations where, let's say, people make mistakes. Well, these mistakes must be exposed because the business depends on accuracy and safeguarding the assets and ensuring the business's survival. So decisions made on faulty information can be dangerous. So it's a system of checks and balances, a system of monitoring to make sure that the business is doing well in terms of its accuracy and its information. So it's doing well in terms of its reporting procedures. Now, the internal accounting controls. Well, the types of internal accounting controls identify transactions that require owner authorization. That may be one way of dealing with the internal accounting controls. Certain transactions have to be authorized, and there may be designated people who can authorize. No one else can authorize, so there is control. If it was the case that anyone can authorize or anyone can sign it off, then there would be a lack of control, and it would be difficult to determine who's responsible for whatever item of expenditure and why it took place in the first place. Ensuring that payments have supporting documentation. It's always the case that we need supporting documentation. If a payment is made, then a receipt should be received, or an acknowledgement. If a payment is sent to a company, say even electronic payment in today's terms, then an acknowledgement from the company should be received. It may be an email outlining the order and outlining the terms of delivery and so on, but it's an acknowledgement that the order was placed. So there is control. The accounting records should be under control. The accounting records should not be kept in the public domain or should be kept open within the business. The accounting records are for approved staff only and should only be dealt with by approved staff, again to maintain the accuracy and the consistency of the accounts. Appointments of senior accounting staff with access to sensitive accounts. It's often the case that within organizations only certain people at a very senior level have access to the accounts, and it's only those people who know what the accounts are, and they're the only ones who can authorize budgets or authorize payments over a certain limit, let's say, or transactions of various kinds. So again, there is considerable control. It's not something which is casual. This is something which is controlled in great detail. Now, evaluating financial performance, well, the ability of the business to meet its financial commitments. For example, pay bills on time. That's very important. It reflects on the reputation of the business. It reflects on the ability of the business to continue in its current form. Otherwise, it may leave itself open to legal action and to disrepute. Its reputation may be damaged. It should also look at the return on its assets. It's important that the business makes a return on the assets, because otherwise investment in those assets was a waste. It would be better put the money invested in the assets, put that money into the bank and get a rate of return, get a rate of interest. So it's important that the return on assets is precisely calculated to ensure that there has been a good use made of the investment funds. Look at gearing and debt management. Look at the amount of debt that the business has got and how it's servicing the debt and what are the terms of the debt. So it's important that businesses are solvent and are capable of meeting their obligations to repay debts, to repay loans that perhaps they've borrowed. And they may borrow money in a variety of forms. It may be long-term loans from the bank or overdrafts from the bank. Overdrafts are very, very expensive, so companies try to avoid overdrafts if they can. They may borrow it in the form of debentures, which is a special type of note that's denominated against the assets of the business, and they seek investors to buy the debentures, and the debentures carry a certain fixed rate of return. Should the company get into trouble and have to liquidate its assets and close the business down, then the debenture holders get the first call on the assets. They are the ones who will be paid first, and all the other shareholders will have to wait until the debenture holders get their monies back, and then what's left is divided up between the other people who have a stake in the business. Financial ratios. Well, the use of selected ratios to evaluate comparative performance. Ratios are good because they enable businesses to make comparisons between themselves and perhaps other businesses. Businesses vary in size, and they vary in the way they're organized and the types of products they make. But it's still possible to work out the performance of one business against another by looking at the ratios. Look at the return on the capital invested, or look at the ability of the business to pay its debts in the short run, the amount of revenue it has versus the amount of debt. So there are all sorts of ratios, and in fact that's the subject of a separate video on the course, and therefore I'm not going to look at this in any great detail here. But it is important to be aware of the importance of financial ratios, so it's important to go back and look at that class. Let's look at an income statement for this company ABC for the year ending 2000 and whatever. And it could be something like this. Sales revenue, the cost of goods sold, and the gross profit. So if we look at the sales revenue, what it received from its sales was £970,000. The goods it sold were a value of 482,000, so the gross profit was 488,000. Now that gross profit, we have to take away the operating expenses. These would be the expenses of the business, which in this case the operating expenses amount to 189,500. So the operating income is now down to 298,500, which is 488,000 less 189,500, giving us 298,500. Now it has to pay interest expenses, perhaps let's say on loans, so 6,500 for interest. So the earnings before tax now is 292,000 £292,000. Now say we have income tax, let's say at 40%, so we take away 116,800, leaving a net income of 175,200. So that it could be an income statement for a business. Now a balance sheet for the company ending the same year, let's say, the balance sheet would be divided into this type of arrangement here. We have, on the top we have assets, current assets and fixed assets, giving us total assets. So total assets for here, for example, here is £744,800. And against those assets we have the various liabilities. And on the principles of double entry that we were talking about earlier, of course, everything must balance, everything must tot up to zero. All the differences must come to zero. So if we go through the assets, we have current assets, which would be cash, accounts receivable and inventories, giving us our current assets, which in this case is £282,300. I'm going to put the cursor onto the screen. £282,300. Fixed assets, buildings and machinery and office equipment and so on, 874,200. Some of that has been depreciated. As time goes by, the assets are not worth as much as they were before. So if we add up all the value that the assets have lost, it's 411,700. So the net assets is 462,500. So that's the net assets. Now if we add 462,500 to 282,300, we get 800. So that's our assets, and then we do more or less the same type of calculation, not the same calculation obviously, but the same type of thinking down here. We have debts, in this case, liabilities and equity. Well, the current liabilities, the accounts payable, accounts which must be paid, perhaps outstanding accounts for raw materials or machines or whatever purchased. So the company owes 37,100. Short-term notes, well, these could be debentures, like I said earlier, or some sort of borrowing that the company has engaged in and has given pledges to return what they've borrowed within a short term. Well, let's say it's got £79,600 worth of short notes. So the current liabilities is 116,700. Then we go to the long-term debt. Now this could be mortgages on the building, perhaps owed to the banks. They borrowed from the bank to buy the premises, let's say. So still remaining is £303,800. So if we add the 116,700 to the 303,800, we get 420,500 here. Now the equity of the business, I'm sorry, I've jumped forward. Sorry. Now the equity of the business, well, ordinary shares, that's what's owed to the people who invested in the business, 140,500. Retained earnings, this is the equity of the business. This is money kept that hasn't been paid out in profits or spent. It's still available to the business, giving the total owner's equity of 324,300. Now, if we add the 324,300 to the 420,500, then we get 744,800, which of course balances with, I've done it again, sorry. Where have I gone to? Just a moment, sorry. Okay, I'll stop putting the cursor onto the screen. I think that's what's knocking me out. If we look at the accounts now, the total assets of 744,800 balances with the total debt and equity of 744,800. So that's the balance sheet, and the balance sheet balances. Should be no surprise in that. Now, some popular ratios. Well, the current ratio, comparing current assets against current liabilities, those coming due and payable within 1 year. So current assets against liabilities. That's current means short term, coming within the next year, let's say. So it's current assets divided by current liabilities. We can go back to the accounts and look at those. It's 282,300 over 116,700. Let's see if we can find it. 282. It's current assets 282,300 over the current liabilities 116,700. So if we take those two figures and work it out, the current ratio is 2.42, which means its current assets are more than twice its current liabilities, which means the business is in good shape. Compare this with the industry norm for current ratio. Let's say the industry norm was 3.02. Then in this case, of course, the business is not in good shape. So we have to look or try to find what's the norm for other companies in this line of production. If we don't make that comparison, I would have thought a figure of 2.42, the current ratio of 2.42 means current assets are more than almost 2.5 times the current liabilities, and that's good. But it so happens it's bad if you compare it to the industry norm. Let's say we found that the industry norm was 3, then of course it's not as good as the other companies in the industry. So the current ratio is used for making comparisons of that nature. That's, as I said, the ratio analysis is dealt with in a separate video. So what we've done in this session is we've looked at the importance of accounts. We've talked about some basic procedures in developing the accounts, how accounts may be done internally, electronically, with software, or giving it off to accountancy firms and looking at the issues involved. And we've also looked at some basic principles of accounting, the cash system versus the accrual system, single entry, double entry, and just mentioned also the idea of the final accounts. And finally we talked about ratios, which, as I said here, is dealt with in a separate class. And that's all I'm going to deal with in this particular class. So let's leave this topic here and ask you to do some work on it yourself. Make sure you've got good understanding of the various topics that came up in this class: single entry, double entry, balance sheet, some ratios and the purpose of ratios, and the accountancy function and the importance of accountancy and stewardship accountancy. But that's all I'm going to deal with, so let's leave it at that and say thank you for watching.